Okay, hi everyone. Welcome to today's webinar brought to you by Vantage. You guys are you're in for a treat, I would say, although today's topic is a bit basic because I don't usually teach you guys technical analysis, right? Because I used to do technical analysis and then Vantage requested that I do geopolitics, microeconomic topics for you guys. But I'm happy to do this technical analysis topic for you guys. Very rare that I do it for you guys because I am actually a technical analysis specialist. So anything to do with technical analysis, love it, can do it very well. Okay. So today's topic, support and resistance. This is the most basic of the basic when it comes to trading. Let me know in the chat box, does anyone not know support and resistance? I'm hoping everyone knows support and resistance. If there's anyone at all who's like who doesn't know it. Okay, yeah. That's what I figured that most people would know it. Okay, cool. So very simple topic, but very important. The most basic part of trading. If you cannot master support and resistance, it will be very hard for you to master technical analysis. Okay, so let's start with the disclaimer. You guys already know how this works. Every time I do these webinars for you guys, I need to remind you that this webinar is purely for educational purposes. Nothing that I share in this webinar is supposed to be any form of signal for you to buy or sell, any form of financial advice, any form of investment advice. There's nothing of that kind at all. Okay, this is purely educational. Vantage made these webinars for you guys so that you guys have a place to come and talk to a professional trader, someone who is in the field. Bring your challenges. I can help you with it, and to learn, especially to learn and see from a different perspective. Okay, so yes, I will have to stay here for a minute so you guys can actually read the disclaimer, then we'll continue. Again, today's topic is very basic, but it's very important for all traders. You need to get the support and resistance right. If not, you would not be able to get the things right when you're doing your analysis. Okay, cool. Hi. Let me see how many of you are on Vantage today. Vantage app. 320 people tuning in on Vantage app. Hello, for those who are tuning in on Vantage app. You guys know how this works. The chat is always moving like crazy, so I don't really get to talk to you guys much unless I scroll up. And even when I'm scrolling up, sometimes whenever there's a new message, it brings it back down to the bottom. Okay, so yeah, those who are on Zoom, I will most likely not miss your messages. Okay, I think you guys should be done. Let me introduce myself. My name is Cassandra. You guys can call me Cass. I am an investment analyst and a prop trader. What that means is that as an investment analyst, my team and I, we do a lot of market research, a lot of forecasting, a lot of understanding where the markets are going, a lot of back testing, a lot of, yeah, basically studying the markets. Okay, because I study the market so much, I'm also a prop trader. For those who don't know what prop trading means, it means that I'm funded by multiple companies to trade their funds. How did I get this funding? I did it by using technical analysis, actually, and a combination of fundamental analysis and also um, by passing their test that requires me to do 10% profit within a month. So 10% profit for me is not that hard. I mean, if you've been trading as long as I have, 10% shouldn't be that hard. Okay, so it's not that hard for me, but it's not exactly easy either, but it is doable. It is definitely doable with a plan. Okay. Okay. Okay, cool. So if you guys have any questions regarding trading, ask me in the chat box. I'll try my best to answer you. Otherwise, yeah, let's just do today's topic. If I finish the webinar early, I mean, all the slides early, we will go into TradingView and I will show you how to do support and resistance on TradingView. Chances are I'm going to finish very early because this is a very simple, straightforward topic. It's not dry. It's not nothing hidden. No special skill. If I was teaching you something like Elliott wave, for example, yeah, I'm gonna need a few hours to teach you that. There's no way I can finish that in an hour. But for support and resistance, we can get this over and done with maybe in half an hour, and then we can go and do a practice session on TradingView after we're done. Okay, so agenda for today is the psychology versus institutional support and resistance, to understand the psychology behind it, why horizontal levels attract liquidity, and when support becomes resistance and vice versa, and common retail mistakes with levels. Okay. So let's start with the psychology and the institutional support and resistance. Okay. Support resistance are often introduced in trading education as simple horizontal lines. Okay. Right? Is that what you guys know it as? You guys can talk to me in the chat box so that it's not this, so that the webinar isn't so boring. But yeah, it's usually as a simple horizontal line. However, in reality, they represent something far more complex. They are areas where supply and demand previously reached temporarily. Okay. So markets remember where transactions occurred in size. When price previously reserved sharply from a level, that location becomes embedded in market psychology and institutional positioning. Traders remember the level because it represents an area where buyers and sellers were previously dominant. However, it is important to understand that these levels are rarely precise prices. They are zones. Okay, they are never one single price. I have literally seen videos on YouTube where people are like, okay, the support and resistance is here. It is one line. It is not one line. Support and resistance is never one line. It is a zone. Okay, it is always a zone. It is a box every single time. Okay, so price discovery is not a mechanical process where every participant reacts at the exact same tick. Rather, a range of prices becomes associated with prior imbalance. The reason these zones matter is that they concentrate decision making. Participants who bought near support may defend their positions if price returns there, and traders who sold their resistance may attempt to sell again. At the same time, traders who were previously stopped out may attempt to re-enter at these positions. Okay, these overlapping decisions create clusters of orders in those areas. Okay, that's why these zones are so important, because these are the zones that people look out for. Okay, so from a structural perspective, support and resistance are simply areas where order flow tends to concentrate because prior activity creates memory. Okay. The memory effects explains why price frequently reacts when revisiting historical levels. The reaction does not occur because the level itself is magical. It occurs because many participants are watching the same area and responding to it. Okay, so the mass majority is what moves the markets. Okay, so psychological levels versus institutional trading, let's understand it. So not all support resistance levels are created equally. Some exist primarily because of human psychology, while others exist because of institutional positioning. Psychological levels tend to form around round numbers. Okay, in foreign exchange market, these often referred to as big figures. So we're talking about like levels such as 1.1, 1.2, 150. Okay, these are the round numbers, the big round numbers that psychologically people are attracted to. Okay, they are naturally attracted to it. I mean, even for me, like, what price did you get in on Ethereum? I will just reply, oh, 1,800. I'll just give a round number, okay? Because it's easier to remember that way. Okay, so traders that gravitate towards these numbers because they are easy to reference and easy to remember. Retail traders often place orders around these round levels. Stop losses cluster just beyond them, and breakout orders accumulate slightly above or below them. As a result, psychological levels frequently coincide with liquidity pools. Institutional levels, however, may not always align with obvious round numbers. Large institutions execute position based on valuation frameworks, macro expectations, and portfolio allocation decisions. These orders placements is often more strategic and less visible to people, to the retail trader. Okay, so for example, an asset manager rebalancing a large portfolio may accumulate positions within a broader zone rather than a single price. A macro fund may scale into exposure across a range based on yield differentials or economic data. Because of this, institutional support and resistance often appear as zones where price repeatedly finds interest rather than precise turning points. Later, when we go into TradingView, I will show you guys what I'm talking about the psychological levels. People keep going to these levels. Okay, so understanding this distinction is important. Retail traders often focus on exact levels, while institutional focus on areas where liquidity and valuation intersects. Okay, so why the market revisits these key levels? Um, sorry, guys. Okay. Markets frequently revisit support and resistance levels because price discovery is an ongoing auction process. Okay. When price moves away from a level quickly, not all participants have had the opportunity to transact. Institutional orders may remain partially unfilled. Traders who missed the move may wait for a retracement to enter. This creates a natural pullback towards that exact same level. So additionally, stop loss orders tend to cluster around prior turning points. When price approaches these areas, liquidity becomes available. Market participants seeking to enter large positions often prefer executing where liquidity is abundant. So this behavior reinforces the importance of key levels. However, okay, the retest process is not simply mechanical. Okay, it reflects a reassessment of expectations. Market participants use the retest to evaluate whether the previous imbalance remains valid. If buyers defend support again, it confirms continued demand. If sellers overwhelm that level, the market transitions into a new phase. So support and resistance are therefore not static barriers, okay? They are checkpoints, okay? Don't look at it as barriers, think of it as checkpoints where the market tests whether prior assumptions about value still hold. So understanding this dynamic helps you, okay, as a trader, interpret price behavior more effectively and avoid treating levels as rigid boundaries. Okay, so why horizontal levels attract liquidity? Let's find out. So liquidity, the real reason price respects levels. When traders observe price repeatedly reacting at horizontal levels, it can create the impression that support and resistance functions like invisible walls. Okay, in reality, the underlying driver is liquidity. Okay, there is actually a explanation to it. Okay, so markets move towards liquidity because liquidity allows large transactions to occur without excessive price impact. Large institutions cannot simply enter or exit positions randomly. If they attempt to execute very large orders in thin markets, price will move sharply against them. Okay, this will in turn create slippage and reduces execution efficiency. Okay, so instead, they seek areas where many orders already exist. horizontal levels, particularly prior highs and prior lows, and range boundaries, naturally accumulate orders. Traders who enter positions earlier place their stop losses around these levels. Okay, breakout traders place entry orders beyond them. The result is a concentration of resting orders. For a liquidity perspective, these levels function like reservoirs. When price approaches them, market participants seeking execution know they will find sufficient opposing orders to absorb their size. Why? This is why price frequently gravitates towards previous highs and lows. It is not because the level itself is meaningful in isolation. It is because the market knows liquidity is likely to exist there. Okay, so in essence, price moves towards areas where transactions can occur most efficiently. Okay, so let's understand the stop loss cluster and breakout orders. The most important source of liquidity around horizontal zones or levels comes from stop loss orders. When traders open positions, they must define risk. This typically involves placing stop loss orders beyond levels that invalidate their trade idea. So for example, okay, traders who buy near support often place stops just below that support level, right? I'm sure we all agree to this. Similarly, traders who sell near resistance place stops slightly above the resistance level. So over time, these stops accumulate in clusters. At the same time, breakout traders place entry orders beyond the same levels. If price breaks resistance, breakout traders buy. If price breaks support, then breakout traders sell. This creates a dense zone of orders, okay? When price finally reaches these areas, the activation of stop losses and breakout orders produces rapid order flow acceleration. This is why breakouts often occur with sudden momentum. The market is not simply drifting higher or lower, it is triggering layers of resting orders. This process is sometimes referred to as a stop loss cascade. Once the first layer stops is triggered, price moves quickly into the next cluster. Each layer of liquidity fuels the move further. However, the existence of liquidity also means these areas can be exploited. If price briefly breaks a level but fails to attract sustained participation, it may reverse sharply. So understanding the mechanics of stop cluster helps explain both powerful breakouts and sudden false moves. Okay, so why markets sweep highs and lows? One behavior traders frequently observe is that the markets often move slightly beyond obvious support and resistance levels before reversing. Okay, so this phenomenon is sometimes described as a stop hunt, but a more precise explanation is liquidity excess. Okay, when price approaches a prior high or low, market participants know that stop orders are likely positioned beyond that level. By pushing price slightly beyond the boundary, those stops become market orders. This creates immediate liquidity. Large traders seeking to execute positions may deliberately push price into those areas because the stop orders provide the liquidity needed to fill the trades. Okay, so once that liquidity is absorbed, the market reassesses direction. If genuine demand or supply exists beyond the level, the breakout continues. If the move was primarily about assessing liquidity, price may reverse sharply back into the range. Okay, this behavior explains why markets often sweep highs and lows before choosing direction. Okay, so from a structural perspective, The sweep is simply the market completing the liquidity discovery process. Only after that liquidity has been assessed can the next phase of price movement begin. So recognizing this dynamic helps um, traders avoid reacting emotionally to brief breaks of support and resistance. So the critical question is not whether the levels were breached, okay, but whether the markets accepted prices beyond that level. Acceptance leads to continuation, rejection leads to reversal. Okay, yeah, we are really going to end this very early. Okay, so let's just end this and then, I mean, soon we got two more subtopics and then we can head to trading view. Okay, so when support becomes resistance and vice versa. Okay, let's understand a few more things and then we're going to move on to trading view. Okay, so one of the most widely observed behaviors in markets is the phenomenon known as role reversal. This occurs when the level that previously acted as support begins to act as a resistance, or when resistance later becomes a support. Okay, so at first glance, this may appear purely technical, but its explanation lies in positioning and psychology. So consider a situation where price repeatedly holds above a support level. Okay, many traders build long positions in that area because they believe buyers are defending that level. Over time, this support becomes widely recognized, right? More and more people will identify that level as a support. Eventually, however, selling pressure overwhelms the level and price breaks below it. Okay, so when this happens, something important occurs. Traders who previously bought that support are now holding losing positions. If price later returns to the same level, those traders may attempt to exit their trades at break even. Their selling creates supply. At the same time, traders who recognize the break of support may interpret the retest as an opportunity to initiate new short positions. These additional sell orders reinforce the resistance. Okay, so everything has its own psychological explanation to why it's happening in the market. So the level has not changed physically. Okay, what has changed is the positioning of participants around that level. Okay, so the same logic works in reverse. When resistance is broken and becomes support, traders who previously sold at that level may be forced to cover positions if price breaks above it. When price retests the level from above, buyers often step in, believing the breakout has established a new structural flow. Okay, so in this way, role reversal reflects the transition of order flow rather than a magical transformation of a price line. Okay, so now let's look at trapped traders and the shift in order flow. To understand role reversal more deeply, okay, we must examine the behavior of trapped traders. Okay, when support breaks, traders who were long above the level are suddenly in a losing position. Some may hold their positions hoping for a recovery. Others place stop loss orders below the level. If price returns to the broken support from below, many of those traders see an opportunity to exit at break even. Their goal is no longer profit, it is damage control. So this behavior adds selling pressure exactly where the support once existed. Simultaneously, breakout traders who initiated short positions on the initial break often view the retest as confirmation of a new trend. They may add to their positions at the same level. The combined effect is a shift in order flow. What was once a demand zone becomes a supply zone. Momentum traders amplify this process. Once the level fails and becomes resistance, trend following participants interpret the retest as continuation rather than reversal. The same mechanism applies when resistance breaks and becomes support. Traders who previously sold the level may find themselves trapped as price moves higher. Okay, guys, give me one. Someone is knocking at the door. Give me 1 minute. Sorry, someone was knocking on the door. Okay, so traders who previously sold at the levels will find themselves trapped as price moves higher. When the price retests the level from above, their stop losses may trigger buying pressure. This interplay between trapped traders and new participants create a structural flip that defines role reversal. Okay, so let's go into the third part of this, which is confirmation versus failure of role reversal. Not every breakout leads to successful role reversal. Okay, so context is very critical. For a level of to truly flip from support to resistance or vice versa, the market must demonstrate acceptance beyond the level. Acceptance means that price remains above and below the level long enough to establish new structure. If price briefly breaks a level but quickly returns to the previous range, the flip has failed. The situation often occurs in range-bound markets where liquidity sweeps are common. Volume and momentum can offer additional clues. A genuine breakout followed by a retest often shows declining selling pressure during the retest and renewed momentum afterwards. So this indicates that the market is accepting the new price area. Multi-time frame analysis is also important. Okay, a level that appears significant on a lower time frame may be less meaningful when viewed in a broader context. Conversely, a level visible across multiple time frames often carries greater structural weight. The key principle is that support and resistance are dynamic rather than static. Role reversal is not guaranteed. It is a hypothesis that must be confirmed through price behavior. The market ultimately decides whether the level will hold as a new boundary or fail and return to its previous structure. So understanding this distinction helps traders avoid reacting prematurely to every breakout and retest. Okay, so common retail mistakes with levels. This is the last part, and then we are basically done, and then we can go into trading view. Okay, so one of the most common mistakes traders make when using support and resistance is treating levels as precise numbers rather than zones. So markets rarely turn at exact prices, like I said, okay? It's always at zones. If you look closely at historical charts, you will often notice that price does not reverse precisely at a single level. It never does. Instead, it may probe slightly above and below before reacting. These movements are not anomalies. They reflect how liquidity is distributed. Orders do not exist at one exact price. They exist across ranges. Institutional participants scale into positions gradually, and stop loss orders cluster at different points within a zone. So retail traders, however, often draw support and resistance lines with excessive precision. They place stop loss orders just a few pips beyond the line, assuming the level must hold perfectly. Okay, this creates vulnerability. If price briefly moves beyond the level to access liquidity, perhaps triggering stops and probing for additional orders, the retail traders is stopped out even if the broader level remains valid. Professional traders tend to think in zones rather than lines. They recognize that support and resistance represents areas of interest rather than exact turning points. So understanding this reduces emotional reactions to minor breaches and encourages more flexible risk management. Okay, so the next thing is ignoring market context. Another frequent mistake is analyzing support and resistance in isolation without considering the broader market context. Levels do not exist independently of the environment in which they appear. In a strong trend, support and resistance behave differently than they do in a range-bound market. During powerful trends, price may break through multiple resistance levels with minimal hesitation because underlying demand remains strong. Traders who repeatedly attempt to sell resistance in a strong uptrend often experience frustration because they are trading against structural momentum. Conversely, in a sideways market, resistance may hold repeatedly while support continues to attract buyers. In this environment, breakout strategies often fail. Higher time frame structures also matters. A support level visible on a 5-minute chart may carry little significance if the daily chart is trending strongly downwards. Similarly, macro catalysts such as economic data releases or central bank announcements can override technical levels temporarily. Support and resistance should therefore be interpreted as part of a broader framework rather than standalone signals. Traders who integrate context into their analysis are far less likely to rely on levels blindly. Okay, so let's move on to the last part of today's webinar, and then we will go into TradingView. A final mistake frequently seen among retail traders is overloading charts with too many levels. Okay, this is one example, but I've actually seen charts where it's like crazy numbers of levels. Okay, so when traders begin studying support and resistance, they often draw lines at every minor turning point. Over time, the charts become clustered with dozens of horizontal levels. This creates confusion. Sorry, I was one of those people. Okay, so if every level is treated as equally important, decision making becomes very difficult. You should only prioritize what is really, really important. Traders may hesitate to act because they perceive resistance and support everywhere. So in reality, the markets tend to respect a small number of major structural levels more consistently than numerous minor ones. Key levels typically emerge from higher time frame swing highs and swing low, major consolidation zones, and areas where price previously experienced strong momentum. So you guys have to remember, the higher the time frame, the stronger the level will be. Okay, so by focusing on these structural significant areas, traders gain a clearer understanding of where meaningful reactions are most likely. Simplicity often improves clarity. Rather than attempting to map every possible level, it is more effective to identify the few areas that have repeatedly influenced price behavior across multiple timeframes. This approach reduces noise, allows traders to focus on the most relevant information. Okay? Okay, so I've got some questions here. Let me answer some of the questions and then we can continue. Okay, right. So why do support and resistance levels sometimes break so easily? Levels break easily when underlying order flows shift. Support and resistance reflects area when buyers and sellers were previously active, but those participants may not defend the levels again. So if market conditions change, it will break easily. So when the demand and supply weakens, the level lost significantly. Also, you need to remember, like I said just now, you need to look at the support and resistance levels based on time frames. The stronger the time frame, the more likely it will hold. The weaker, the smaller the time frame, more likely it won't hold. Okay, so should traders always expect a reaction when price reaches a key level? Okay, not necessarily. Context matters. Levels increase the probability of a reaction, but they do not guarantee a reaction. Okay. Okay, so the markets may pause briefly because continuing in the same direction is if underlying momentum remains strong. Okay. Is support and resistance enough to build a trading strategy? Support and resistance is a very useful tool. Okay. Okay, it provides very useful context, but they are rarely sufficient on their own. Okay, you cannot just base on one technical analysis tool. You need a combination of things. So most traders combine levels with market structure, momentum, and a broader context to improve decision making. Okay, do the big traders use support and resistance the same ways as we do? The big traders, I'm assuming you mean the institutional traders, right? The big whales. Okay, institutional traders, right? The whales, they are aware of the same levels because when they open the charts, they can see the same thing that we are seeing. Okay, but they often view them primarily as areas of liquidity rather than exact entry signals, unless you are thinking the same way as them. Okay, they use these zones to manage large orders rather than relying on them mechanically. Okay, so I think if you guys have any more questions, ask me in the chat box. Otherwise, I'm going to pull out TradingView. Okay, I think you guys are more excited about the TradingView. Give me a moment. Let me pull it out. I had it pulled out just now and I accidentally closed it. Okay, let's go. TradingView. I really do not. Yes, continue with me. I really do not like the lines in the background. Can you guys give me a minute to just... no, I don't know what I just did. Okay. Give me a moment, guys. I'm trying to get rid of the lines in the background. It's just that my other TradingView account already set everything. Okay, there you go. Okay, there you go. Sorry, the lines in the background was bothering me. Okay, let's do EUR USD. Hello, my name is you. You have explained the support and resistance levels are zones, not a single price level. How do you define the thickness of the zone? Okay, let me show you in a bit. I'll show you on TradingView. How do you define the thickness? And how do you know if a support resistance level is broken? Is it when displacement candles occur? Like when a sudden big price movement happens in a short time, breaking that level? Okay, yes. Very good questions. Let me show you exactly. So let's do EUR USD. Okay, let's look for Vantage because we are on Vantage. See at the side, there's a lot of brokers with a lot of charts. You've got every other broker in the market, very big brokers, and Vantage is one of them. Vantage is a very big broker. Okay, so how do we identify support and resistance? Okay, so how to identify support and resistance? You first need to identify swing highs and swing lows. Okay, this is super duper duper important. Swing highs and swing lows will be the answer to identifying support and resistance. So let me pull out a pen. Okay, this is a swing low, this is a swing low, this is a swing low, this is a swing. Well, price is still moving, so I cannot really consider that a swing low. That's a swing high, a swing high, a swing high, swing high, swing high. Obviously, you don't take every swing high, you take the most significant one that is showing. If you are confused at which one is significant, Honestly, it's easier to change your, this is not my chart, it's to a line chart. Okay, so a line chart will show you the very significant swing highs, swing lows. I mean, sorry, it's not a very good swing low to take because price is still moving. Swing low, swing low, swing low, swing low, swing low. Okay, these are going to be your horizontal levels. Okay, I'm gonna move back to the candle bar. Okay, so how do I identify swing highs and swing the horizontal levels? I'm going to find one level where price is constantly going to. Okay, why did I choose this level here? Okay, now that I've chosen this level, now let me choose a zone. How do I identify zones? You draw a box where you see price has moved there many, many times. So this is the zone that I have chosen. Okay, why did I choose this zone? Because if you guys look closely, you can see price coming here one time. It came here second time, it reacted and then it broke out. So that's not really counted. This is not counted, okay? Two times, three times. If I lengthen this zone, this is the second time, sorry. Okay, for third time, fourth time, fifth time. If I lengthen this zone again, it becomes the sixth time. Okay, and now we are at the seventh time. Do you see how 7 times in the past price came here and then it reacted off this green box? You see that? That's exactly how you identify zones. Zones are areas where price constantly reacts off it repeatedly. Just imagine the zones like magnets. I hope that answered your question, Yuko. And how do I know if there is a break? Okay, so to answer your next question, how do I know if there is a break? This is a very good example, actually. Okay, you see how price broke this candle here? You've identified your zone, and then it breaks the structure. So it breaks the last swing high here, and then it closes, the candle closes. Okay, it's different from wicking. It is different from wicking. So an example of wicking is this. This is wicking. You see this candle here, if the wick went above the zone, that's not counted. I need a body candle. I need the body to close above the zone for me to consider it a breakout. Okay? I hope that answers your question. I need the body to answer to the body to break out of the zone and close above that zone for me to consider a breakout. Okay, now that I have my zone, where exactly, let's say I have my zone, right? So this is the zone that we have identified. Price have reversed off here one time. I'm going to change the color of this to maybe purple, okay? One time, it reacted here 2 times, reacted 3 times, reacted 4 times, reacted the 5th time, and now we are on the 6th time. Reacted as in it has used this green zone as a support area. Okay, this green zone has become a support area in the past for 6 times. So now we are at the 6th time. The question is, or the 6th time is complete. Let's say this is done already and price goes up and later it wants to come down for the 7th time. Where in this green zone are we going to enter for a buy? Where in this green zone are we going to enter for a buy? Because you think about it, right? When you think about it, 1.15800 all the way to 1.15400, that is a very big zone. So where exactly am I going to put my buy order? So let's say I've decided to get in for a buy. Where do I put that buy? Do I put it here? Do I put it here? Do I put it here? Where do I put the buy? Okay, so Another thing you can do is narrow down your zone. So I know there is a good chance that price is attracted to this green box, but where exactly in this green box it is most likely attracted to? This is why someone asked just now, is support and resistance enough to build a strategy? No, support and resistance is not enough to build a strategy because support and resistance will give you this green box. But how do I narrow down this green box? How do I know where to put the entry for this green box? You need to combine other things. You need to learn other technical analysis tools. So I'm going to show you Fibonacci, which is not part of today's topic, but I'm going to show it anyways. Give me a moment. I'm gonna go down to the smaller time frame so that I see more structure. Okay, why is it not going? Come on, come on. Go down. Is it because I'm on a free account? Sorry, I cannot log into my other account because that is based on my prop trading. Okay, so I cannot use that account. I'm only allowed to use this free. Hold on, guys. Let me refresh this. Okay, now we're on the 4 hours. Okay, so, oh no, we're not even on the correct chart. UURUSD. Hey, did you bring me to gold? Okay, let me identify the same zone just now. This is the box. This is the box that I was looking at just now, right? This is the box. The price is constantly reacting off. Price reacted off this box a few times. Okay, so I'm gonna narrow down the box. You go to the small time frame to find a clearer box. So what am I identifying right now? I'm identifying more horizontal levels. Okay, so based on recent times, okay, there were 2 levels where price reacted off. The first one is here to here. Okay, so I'm gonna change this to, I know price is attracted to the green box, but in the recent time, price came to the red box a lot of times. So it came here 1 time, 2 times, and 3 times. We are now at the red box the 3rd time. And the other zone that I noticed price going within the green box is here. You see that? Price came here 1 time, came here 2 times, 3 times, 4 times, I mean 5 times. Okay, so you can see there is 2 zones that price is kind of attracted to. Or if I can make this red one even wider. Okay, so again, based on past history, based on what we see on the charts, I am not making things up. Okay, we are all looking at the same charts together. Okay, price in the past has come to this green box many times, but more recently, since the 14th of October until now, it has gone into the red box a few times and gone into, I'm going to change this to blue, the blue box a few times. So if price were to come here again, if price were to do whatever it wants to do and then come here again, my bet is it's going to come to this red box or this green box. It's going to come somewhere within this green box, but more likely somewhere within this blue box or somewhere within this red box. Do you see how I've narrowed down the possibility of what's going to happen by going down the lower time frame? Anyone confused as of right now? Is everything clear? Am I explaining it as simply as I can? I don't know if you guys are understanding what I'm saying. If you guys understand, if you guys are still following me, type in the group, type it in the chat box so that I know that it's clear. Because if not, I can just repeat again. Don't be shy, guys. And understand, clear, got it. Okay, thank you. Okay, so right now, your job as a trader is to narrow down where the action is going to happen, and then narrow it down some more, and narrow it down some more, and narrow it down some more until you have a rough idea of where exactly it's going to happen. So right now I have a possibility. Okay, so I'm going to write my scenario of what I think has happened. In the event price comes down again, it is most likely going to come down to this green box. But within this green box, more specifically, it's going to come down to the box labeled A or the box labeled B. It can go anywhere within the green box, but more likely, it is most likely going to go to A or B. Okay, so now that is done. I know that A or B is the highest possibility of where price is going to go. How do I know if it's going to be A or if it's going to be B? This is why, again, support and resistance is not enough. Okay, so now I am going to pull out Fibonacci levels. Okay, for those who don't know what Fibonacci levels are, I'm not going to teach you because we only have a few more minutes left. There's no way I can teach you Fibonacci in the last 6 minutes that I have with you guys. You guys will just have to research on your own or wait for a time where we have a webinar on Fibonacci. Okay, so Fibonacci 1, 2, 3, the third one. Fibonacci is based on the idea that price likes to go to one of these levels. Okay, price likes to go to one of these levels. Okay, that's too far away. This is too far away from the red or the blue box. So within this green box, we have already narrowed down that it's going to be the red or the blue box. But which one is it going to be? Let's try to find out by using other technical analysis tools. Okay, that Fibonacci didn't work. Let's try Fibonacci projection. 1.6. Nope. Let's try. Fibonacci retracement. Okay, so I'm going to get rid of every level that is not in the green box. Okay, anything that's not in the green box is not relevant to us. Because remember what I said just now during the slides, I said there are people who take every level of significance and therefore they cannot find an entry because they give importance to too many levels. Okay, so anything that's not in the green box, we do not want to focus on it. Okay, we want to keep narrowing down, narrowing down, narrowing down until we find something that makes sense. This is really far already, but I have no choice because I cannot really find anything. Not in the green box, getting rid of it. Not in the green box, getting rid of it. Not in the green box, getting rid of it. Okay? Give me a moment, guys. I need to 1, 2, 3. Okay, this might work. One 1.272, 1.613. Okay. This is not a very good example of how this should be working, okay? This is not a very good example, honestly. So ideally what I was trying to show you guys is that with Fibonacci levels, if you combine support resistance with Fibonacci level, you should be able to find a cluster of levels lining up in the exact same area. Okay, but today it's not happening because of the structure of the charts. We cannot force things to happen. Okay, if it's not happening, then it's not happening. Okay, so right now we've got a 50% Fibonacci retracement lining up at the red box. So there's another 61.8 here, but it's not lining up within the green box. So it makes me think that the green box is not as strong as the red box. So in the event price were to come here again, I am a bit more biased that it's going to react off the red box rather than the green box. Oh, sorry, the blue box. Okay. What do you think about candlesticks patterns like shooting star hammer? Okay, candlesticks patterns will help you in one way, or it will help you in trading, but don't put too much significance into it. When I put importance into trading, I have a cheat like a priority list. So priority is always horizontal levels. Horizontal levels plus Fibonacci levels are always the priority. Okay, so if the horizontal level is telling you that it is a sell or is a buy or whatever it is, but a candlestick, like a candlestick is showing you that it's a reversal pattern, take it with a pinch of salt, because candlesticks, although they tell you a story, the significance and the strength of it isn't that level, isn't that important. So horizontal levels plus fib levels, and then we've got trend lines. Okay. And then we've got indicators. And then we've got candlesticks. So if I have to put the importance of what I think, where I think price is going, candlesticks is actually the least important thing that I look at. It is the last thing that I look at. So don't put too much significance into that. Okay, so that's all I have for you guys today, because my time with you guys is up. Basically, I hope that you guys have learned something from me and learn how to identify support and resistance. I mean, I have another minute. Let me just try to show you on gold. Where is Vantage? Vantage, there you go. Okay, you see how I put buy here and there was a buy here. You see that? You see how I found this buy here, even though there were no horizontal levels. I found this buy because there were a lot of Fibonacci levels lining up in this exact same area. Do you guys see that? There's a lot of Fibonacci levels lining up in the exact same area. So on top of horizontal levels, if you learn Fibonacci, it will also help you identify horizontal levels very well. Okay, so I chose gold because gold likes to do horizontal levels. Okay, so I'm gonna identify a horizontal level now. This is how you identify horizontal levels, okay? You choose a zone where price has reacted off many times. Okay, you just need to train your eyes to see it. Okay, price came here one time, reversed, came here two times, reverse, came here three times, reverse, came here four times, the fourth time it reversed. So it was once a resistance, now it has become a support. Came here the fifth time, reverse, came here the sixth times, reverse, and came here the seventh time, reverse. So you know for a fact this purple zone, or what color this is, whatever color this is, I'm going to change it to purple. This purple zone is in fact a zone where price likes to react off. This is very important to identify, because the next time price comes here, then you will have your opportunity to get in for a buy. Okay? You will have your opportunity to get in for a buy, because you know every time price comes here, it tends to react. It tends to reverse. So the next time price comes here, you can anticipate a buy. Okay, where in this green box, sorry, where in this purple box? It's going to be somewhere in this purple box, but where? Okay, so in this case, if I'm looking at recent movement, I would say it's most likely going to be somewhere around here. Okay, price is most likely going to enter this purple box and reverse off this purple box, but more likely within this blue box. Why? Because in recent times, price came here one time, two times, and three times, and it reversed. So if it comes here again the fourth time, chances are it's going to reverse here. Okay? I hope that helps. I see you guys next week. Next week, it's not going to be a technical analysis topic anymore. It's going to be another topic. I'm gonna go back to geopolitical stuff, macroeconomic. Yeah. I think next week we're going to talk about oil actually, which is a good topic to talk about because of what's happening in Iran. Okay, so I'll catch you guys in a week. Take care, everyone. I hope you learned something from me today. Or if not, I know some people they cannot really like recognize patterns, but you just have to train your eyes, okay? You look at the charts long enough, you're gonna start seeing this. Okay, if you cannot see it, if it's very confusing, you still cannot see what I'm talking about, change it to a line chart. Okay, a line chart will be clearer. So you came here one time, two times, three times, four times, five times, six times, seven times, eight times. Okay, you see how you just train your eyes, you'll eventually be able to see what I see. Okay, so bye everyone. Take care. See you guys in a week. Yeah, enjoy the rest of your week. Bye.